Hello and welcome back to Investing Iguana. I'm Iggy, your guide through the intricate world of investments. Today, we're diving into a hot topic in the crypto universe with our video Bitcoin ETFs, why Asian regulators are hesitating. In this video, I'll unravel the reasons behind the cautious stance of Asian financial watchdogs towards the recently approved Bitcoin ETFs in the US. Despite the global enthusiasm surrounding these ETFs, countries like South Korea, Singapore, and Thailand have shown reluctance to jump on the bandwagon. We'll explore the factors driving this hesitancy, from protecting retail investors to potential strategic moves to foster local markets. So, if you're keen to understand the dynamics shaping the future of crypto investments in Asia, you're in the right place. Let's get started and shed some light on this intriguing development. Asian regulators, traditionally quite open to new financial products, surprised many by warning brokerages against allowing their clients to invest in these new overseas ETF offerings. This includes funds from big names like Fidelity, ARK Invest, and BlackRock's iShares. Even Taiwan stepped up, defining Bitcoin as non-securities, essentially blocking these ETFs under their current regulations. Why such a cautious approach? Well, protecting retail investors from fraud is a big part of it. With the UN reporting over $17 billion in criminal activities connected to Tether in Southeast and East Asia alone, it's clear why there's an urgent push to fight crypto crime. But there's another angle here, giving local efforts time to flourish. Could it be that Asian markets are strategically paving the way for their homegrown solutions? When we take a step back and look at the global financial landscape, it becomes clear that the Asia-Pacific region has emerged as the most rapidly expanding market for exchange-traded funds, ETFs. ETFs are investment funds traded on stock exchanges, much like individual stocks. They have gained immense popularity due to their ability to offer broad market exposure, liquidity, and relatively lower costs. In the Asia-Pacific region, more than $1 trillion has been invested in ETFs, underscoring the significance of this market. This is not a small figure by any means, and it highlights the substantial role that ETFs play in the region's financial ecosystem. Asian investors, in particular, have demonstrated a strong interest in ETFs. Their investment in these funds has grown at a rate that surpasses the global average. This indicates a robust appetite for such financial instruments among investors in the region, and it also suggests a sophisticated understanding of the benefits and risks associated with ETFs. However, despite this enthusiasm for ETFs, there seems to be a certain hesitancy in the region to embrace Bitcoin ETFs that have received approval in the United States. Bitcoin ETFs are a type of ETF that tracks the price of Bitcoin, allowing investors to gain exposure to this cryptocurrency without actually owning it. The reluctance to adopt US-approved Bitcoin ETFs may not necessarily be due to a lack of interest or understanding of this innovative financial product. Instead, it could be more about protecting the integrity and stability of local markets. It might also be a strategic move to buy time for the development and launch of similar products on their own terms, ensuring they meet the specific needs and preferences of Asian investors. This approach allows the region to maintain control over its financial landscape while also keeping pace with global advancements in ETF offerings. In an intriguing development, there have been increasing demands within Asian financial markets, particularly in places like Hong Kong, to expedite the approval process for Bitcoin ETFs. This is a noteworthy trend as it indicates a clear and growing demand for regulated cryptocurrency products within these markets. Bitcoin ETFs, which track the value of Bitcoin, offer investors a way to gain exposure to the price movements of this leading cryptocurrency without the need to directly own or manage it. This makes such ETFs an attractive option for those who wish to participate in the cryptocurrency market while mitigating some of the risks associated with direct ownership, such as security and storage concerns. The calls for faster approval of Bitcoin ETFs are not happening in a vacuum. They are taking place against a backdrop of increasing acceptance of Bitcoin and other cryptocurrencies by major players in the global financial industry. For instance, Wall Street giants like BlackRock, one of the world's largest asset managers, are now advocating for Bitcoin. This endorsement from a major financial institution lends significant credibility to Bitcoin and underscores its potential as a legitimate asset class. This advocacy from Wall Street puts considerable pressure on Asian regulators. The clear demand for Bitcoin ETFs and the endorsement of Bitcoin by major financial institutions create an expectation for Asian regulators to provide access to such investment vehicles. This is not just about meeting investor demand, it's also about ensuring that Asian markets remain competitive and relevant in a rapidly evolving global financial landscape. So, what does this mean for investors in Singapore and across Asia? It's a complex landscape. The evolving landscape of digital assets presents a complex scenario for investors in Singapore and across Asia. This complexity arises from a multitude of factors that are at play in the world of cryptocurrencies. On one side of the equation, there is a pressing need to safeguard investors from the inherent volatility and the often opaque nature of the cryptocurrency market. Cryptocurrencies are known for their price fluctuations, which can be extreme at times, and this volatility can pose significant risks to investors. Additionally, the lack of transparency in some aspects of the crypto world can make it difficult for investors to make informed decisions. On the other side, there is a burgeoning demand for regulated access to digital assets. More and more investors are recognizing the potential of digital assets and are seeking ways to incorporate them into their investment portfolios. However, they want to do so in a manner that is regulated and offers some level of protection. This puts Asian regulators in a challenging position. They are essentially walking a tightrope, trying to strike a balance between two equally important but somewhat conflicting objectives. On one hand, they have a responsibility to protect investors, which could entail imposing restrictions and regulations on the trading of digital assets. On the other hand, they also need to ensure that their financial markets remain competitive on a global scale. This could mean embracing digital assets and providing regulated access to them. And there you have it, a comprehensive look into why Asian regulators are hesitating to embrace Bitcoin ETFs. From concerns over market stability to strategic economic planning, we've covered the various angles that are influencing these decisions. Understanding these factors is crucial for any investor looking to navigate the evolving landscape of cryptocurrency investments, especially in Asian markets. If you found this analysis enlightening and want to stay updated with more such in-depth financial content, please hit that like button and consider subscribing to Investing Iguana. Your support helps us bring you the latest insights and analyses from the world of investing. Also, feel free to share this video with fellow investors who might find it useful. Remember, staying informed is the key to smart investing. Stay tuned for more from Investing Iguana, where we make sense of the market's twists and turns for you. Until next time, invest wisely and stay ahead of the curve.